to today's report on the 9th of April 2025. So what's in store for us today? All right, today I'll talk a bit about this title. Bear market in motion, are short still the smart bets? Do you still want to short? Okay. Now, a lot of people have been talking about short, how bad the market is. We have been receiving a lot of inquiries, and one of the biggest inquiries was that, the one that received the most was whether shorts is still the way to go going forward, right? So we are going to study from multiple aspects, okay? Mainly the stock market, and then you can look at the US bonds, for example. That will give us a better idea, roughly how far can this thing still go. And finally, we are going to address the question, is the recession coming, given this situation that we are in, right? So first of all, the US stock market, the conditions and the risks. As of April 2025, the US stock market have experienced a sharp downturn, with the S&P 500 down 21.3% from its peak, and the Nasdaq Composite off 25.6%. Now, this qualifies as a bear market, as decline more than 20% is generally considered a bear market threshold. Now, historically, such steep declines often coincide with recessions, but there are exceptions like in 1962, 1987, and 2022, where a bear market did not lead to a recession. Now, the VIX, okay, for those that are still new, when I talk about VIX here, it's layman terms, it's the fear index, how fearful the market is. So on April the 7th, the VIX surged to 60.13 points and closing at 46.93 on April the 8th, now hitting one of its highest levels since the 2008 and 2020 crashes. Now, this spike suggests capitulation, like fear often seems near market bottoms, okay? So that's why it suggests capitulation. That means we are nearing the bottom already when they spike that much. And I've also spoken about it before in the previous articles, watch out there. The previously we had 12 to 15% is just a normal retracement, but now we have moved into bear market territory, and you have the VIX now surging. So there is this possibility of capitulation. We have also seen certain asset classes, even though they drop, they don't really drop that according to the speed, that we think it could drop, but rather more of a gradual kind of drop that also suggests, the sellers, they are selling, no doubt, but they are wary. They're not targeting very far targets. So basically, historically, big spikes above 50 have preceded strong short-term rebounds, but not always durable ones. In both 2008 and 2020, markets continued falling even after the VIX peak. Okay, now this extreme fear level shows forced liquidation is underway, but without a clear catalyst like a Fed pivot, they're going to cut rates, or easing trade tensions, a durable bottom is unlikely yet. Okay, so unless there's a catalyst saying something, it could still continue to go down, albeit in a slow manner. Now, the VIX move should caution traders against initiating fresh shorts here, but it doesn't eliminate downside risk. So if you want to sell, don't target that peak. So as a conclusion for shorting stocks, short positions in US stocks may still have downside potential if recession risks materialize. If economic data weakens further or corporate earnings drop, there could be additional declines. However, as much of the bad news is already reflected in prices, those shorting stocks should watch for policy changes or economic stabilization as potential signs to cover shorts. Now, this is one thing, you can short. I'm not saying you can't short stocks here, but you have to be careful. Like today, in the news, they you get more and more US lawmakers, they are making noise saying, this is getting too much. It is like a global tariff kind of thing, is causing too much stress to the stock market, and they might go against Trump's policies, and say, hey, you can't simply just put on tariff and that much at that level and being insist thing on certain things up to the point where it really is going to destroy the economy. Okay, so because last night, like in like say in 2 hours, the US is going to add another 50%. That will bring China's tariff threshold surpassing 100%. So this kind of news, it brings a lot of stress to the market, and knowing that China said that we are not going to take all this lying down, we're going to fight until the end. Now, this kind of news is not welcome, and it causes a lot of panic in the market, and that's what you've been seeing. But even with this kind of situation, we can also say that the market has already priced in, because with the announcement of Trump saying that China is we're going to put another 50% on China, just because they retaliated on Friday, the market, the S&P 500, Nasdaq, they haven't made a new low yet. It could do it later today, but the thing is that if the news is really bad, we would have seen the market, the S&P 500, Nasdaq already making new low with yesterday's announcement, right? You have not seen that. So there's still a possibility that the sellers, they are wary. That's the reasons why I said it's not to say you can't short, you can, but monitor your profits. Don't take big profits, okay? Now, from a US bond perspective, how we're going to look at. Now, I am focusing mainly on the 10-year treasury. It has been volatile. Early in 2025, yields were expected to rise, with some predicting a move towards 5% due to inflationary pressures and increased government debt, particularly from tariffs. However, by April 2025, the 10-year yield has fallen to around 4%, its lowest level since October 2024. Now, the drop in yield was driven by a safe haven bid, with investors seeking the relative safety of bonds amidst escalating trade tensions and fear of recession. In fact, the 10-year yield briefly dipped as low as 3.86% during this period. Now, given the shift towards recession concerns, bond prices are rising, making shorting bonds a less attractive strategy. Now, the yield curve remains inverted, with the 3-month Treasury bill yield exceeding the 10-year yield, which has historically been a signal of recession, right? So conclusion on shorting bonds. The case for shorting bonds has weakened. If a recession occurs, Treasury yields are likely to fall further as investors seek safe assets. Now, with inflation expectations modestly above 2% and the Fed expected to cut rates further, long bonds become more favorable than shorting them. Now, shorting bonds carry significant downside risk, and unless inflation continues to surprise to the upside, the environment is shifting towards longer-term bond positions. Okay, so now the question beckons: is a recession coming? The risk of a recession is rising, no doubt, with every single day. Several indicators suggest that U.S. economy is teetering on the edge of a downturn. Now, yield curve inversion, the 3-month T-bill I've said earlier, has been above the 10-year yield for several months, deepening as the curve inversion reached about negative 50 basis points at times. Historically, this has been one of the most reliable recession signals, okay? But it's not like it's going to happen immediately. It can always come later, okay, before that. So it will take some time. Yeah, the possibility is there. Now, Conference Board Leading Economic Index, the LEI, fell by 0.3% in January 2025, extending its decline to 0.9% over the last 6 months. While this isn't a dramatic drop, it indicates slowing momentum. Now, unemployment, the US unemployment rate rose from 3.5% in 2023 to 4.1% in early 2025, a 0.6% increase, which is a warning sign of a potential recession. Historically, an increase of 0.5% or more from the unemployment rate lowest level often precedes a recession. Now, these are all just statistics, okay? So despite these warnings, there is still a chance that the US economy could experience a soft landing. Major investment banks like Goldman Sachs raised the likelihood of a recession to 45% in early April 2025, citing escalating trade tensions and disruptions caused by tariffs. So if all this is basically being removed, then it could be just a soft landing. So conclusion on recession, key indicators like the yield curve inversion, falling LEI, and rising unemployment point to increase recession risk. Major banks like Goldman Sachs, J.P. Morgan have raised their recession probabilities to 45 and 60% respectively. For me, I think traders should remain cautious as the possibility of mild recession is growing, but it's not a certainty. So because we are already that low already, want to sell, go and sell. Every time, let me show you something. Whenever prices make a new swing low, okay, it goes up and you're selling. Like, yeah, on Monday we saw price S&P 500 moving up, Nasdaq moving up. Then yesterday the announcement, it started to move down, right? So keep on selling until it takes off. It makes a new low. This is the place you need to make a decision either to take full profits or gradual profits while protecting your entries. That's one of the easiest way. And then trail your sales with every lower low being made. I think that's one way to deal with the current market situation. Okay, so with that, that's the report for today.